Do you think the rise of the US stock market is a boom? You're wrong. It may be the greatest illusion in history. The performance of the US stock market has recently left many investors perplexed and unnerved. The market seems immune to negative news. Whether it's rising inflation, downward revisions to the jobs report, or Trump's renewed use of tariffs, nothing can stop its surge. This strange, seemingly unstoppable atmosphere is like a grand ball. The music gets faster, the lights get brighter, and everyone's partying. But the dance floor beneath their feet may already be cracking. Hi, I'm Daryl Hart, a blogger who enjoys financial gossip. Today, we'll analyze this situation and explain how to hedge your bets. Interest rate cuts. The danger beneath the mask of gentleness. The Federal Reserve's recent interest rate cuts seemed like a mild boost for the market. They lowered rates by 25 basis points. However, it was a few words from Fed Chairman Powell at the press conference that truly ignited market sentiment. This rate cut is a risk management exercise. These words resonated like thunder across the conference hall. A year ago, Powell used the same phrase, which was followed by a series of rate cuts totaling 100 basis points. When reporters pressed him on whether this rate cut was sufficient, Powell simply replied, "We'll have to see the full path." The implication was clear. This was just the beginning. The rate-cutting train had begun and would continue until reaching the neutral interest rate level. The market went into a frenzy. Traders reacted quickly, as if energized. CME data showed nearly unanimous market predictions of further rate cuts of 25 basis points at the Fed's two remaining meetings this year. Some boldly predicted that, by the end of 2026, interest rates could be 125 basis points lower than they are now, falling to around 3%. This is no longer just the market cooling down. It's like a burning fuse that's directly pushing market expectations to a climax. Interest rate cuts, a stock market antidote or poison. Many people believe that interest rate cuts lead to stock market gains. However, history tells us that the story is far more complex. Over the past 3 decades, the U.S. stock market has experienced numerous interest rate cuts with vastly different outcomes. When economic crises erupted in 2001 and 2008, interest rate cuts were like pouring water on a raging fire. Instead of extinguishing the flames, they fanned even thicker clouds of black smoke. The market collapsed, and the cuts proved futile. However, in 1995, 1998, and 2019, interest rate cuts acted as a lubricant for the stock market, fueling its relentless surge. Why such a dramatic discrepancy? The answer lies not in the cuts themselves, but in the state of the underlying economy at the time of the cuts. If the economy is already in decline, interest rate cuts are a last-ditch effort and cannot reverse the decline. However, if the economy is still stable, cutting interest rates will provide timely assistance and inject new vitality into the market. Employment data, a glaring contradiction. So, is the current U.S. economy healthy or seriously ill? Employment data is the best reference for answering this question. However, the current data presents a contradictory picture. On the one hand, non-farm payroll data has plummeted. Since May, monthly job creation has averaged only 27,000, which is a stark contrast to the previous norm of 120,000. Historically, such declines often precede recessions. On the other hand, initial unemployment claims have remained remarkably stable. The layoff rate is an exceptionally low 1.1%. Businesses seem to be in a strange state. They are reluctant to hire on a large scale, yet are not engaging in large-scale layoffs either. The answer to this seemingly inexplicable contradiction lies in manufacturing data. The manufacturing PMI index soared to 53 in August, a 3-year high. This indicates that businesses have a large number of orders and strong production demand. However, due to uncertainty surrounding tariff policies, companies are hesitant to expand production capacity or hire new employees. Therefore, the job market appears contradictory, but it is actually a result of companies collectively adopting a wait-and-see approach. Consumption, a solo show for the rich. Where does business demand come from? Ultimately, it all comes down to consumption. The most direct way to understand consumption trends is to examine Bank of America's credit and debit card data. In August, consumption grew by 1.7% year-over-year, marking the third consecutive month-over-month increase. However, behind this seemingly unremarkable figure lies a startling truth. High-income households are the primary drivers of consumption. The richest 10% of American households account for half of all national consumption, a proportion that continues to break historical records. Why can these wealthy individuals afford to spend so lavishly? The answer lies in the relentless rise of the stock market. In the United States, more than half of the wealthy's wealth is tied up in stocks. When the stock market soars, their wealth instantly increases. Even without additional cash inflows, this paper wealth creates a strong impulse to spend. This is the so-called wealth effect, which translates into a frenzy of overspending. The extravagance of the wealthy supports demand, which supports businesses, which support employment, which, in turn, supports the entire economy. A stifling cycle. When these seemingly independent threads are put together, a stifling positive cycle emerges. A rising stock market first stimulates consumption among the wealthy. This increased consumption provides businesses with a steady stream of orders. Ample orders naturally maintain a stable job market. Stable employment, in turn, supports overall economic growth. Continued economic growth provides strong support for the stock market, driving its continued rise. This cycle isn't a simple cause and effect relationship. It's a self-reinforcing loop. The stock market's rise is both its starting point and its ultimate outcome. This is why, while watching the U.S. stock market, many people internally curse the false prosperity, yet acknowledge that it simply won't fall. Three blades hanging overhead. This seemingly indestructible cycle has its weaknesses. Hanging above it are three sharp blades, poised to fall at any moment. The first blade is the Federal Reserve. Interest rate cuts are the spark that ignites this cycle. If the Fed stops cutting rates or reverses its policy, the cycle will lose momentum and eventually die out. The second blade is policy risk. In particular, tariffs. If negotiations break down, businesses will continue to adopt a wait-and-see attitude. This could tear apart the protective net that supports employment, which would deal a fatal blow to the entire cycle. The third knife, AI. Over the past 2 years, AI has been the primary driver of U.S. stock earnings growth and the turbocharger of this cycle. If AI development suddenly stalls, this positive cycle will instantly end. Fortunately, none of these three factors have negatively impacted the market yet. The path to interest rate cuts remains clear, tariff risks are receding, and the relentless momentum of AI continues unabated. Therefore, in the short term, we don't foresee anything that could derail the cycle. Undercurrents in the feast. Therefore, I am optimistic about the future performance of the U.S. stock market. Although the index has rebounded nearly 30% since its low in April, I believe this rally still has significant room to grow and strong momentum. Of course, the market won't be smooth sailing in the short term. The stubbornness of inflation and the lagged effects of tariffs may cause market volatility. However, given the overall momentum, these are merely minor interludes, not the beginning of the end. For investors, the real significance of this bonanza lies in asking yourself, what does this situation mean for my 401k and portfolio? Currently, if your portfolio is primarily in the S&P 500 or large-cap growth stock fund, your paper gains may look impressive. However, it's important to understand that this boom depends heavily on a few giants. While there's nothing wrong with holding on to these stocks, you may want to consider diversifying your portfolio by adding some small-cap or value stocks. Historically, small-cap stocks tend to outperform large-cap stocks during economic recoveries. If this cycle suddenly breaks, the most important thing is to preserve your principal, not pursue returns. Gold and silver often serve as safe havens in times of crisis. Cash and short-term treasury bonds provide flexibility, allowing you to withdraw funds when necessary. High-quality bonds also provide a buffer. In other words, bull markets rely on growth, while crises rely on cash and safe havens. This is why the metaphor of the three knives is so pertinent. Once the Federal Reserve suddenly changes its approach to interest rates, technology stocks will inevitably bear the brunt of the pressure because their high valuations depend on low interest rates. If tariffs become an issue again, manufacturing and retail industries will suffer, and rising corporate costs will eventually squeeze profits. If the AI narrative dies down, leading companies like NVIDIA may experience a decline in value. Although the long-term demand for semiconductors and cloud computing still exists, the short-term valuation bubble will inevitably burst. A more subtle aspect lies in the wealth effect. Many middle-class individuals wonder, why is the market still rising when our finances are clearly tightening? The answer is that the richest 10% of households are driving overall consumption. Their purchasing power is equivalent to half the nation's, making the statistics appear robust. However, this prosperity masks structural risks. For example, a surge in credit card debt is already occurring. If default rates begin to soar, the cycle could snap. The real danger is that the bubble may first burst among the wealthy because their consumption depends most heavily on the wealth effect of the stock market. Once asset prices reverse, the effects will spread throughout society like dominoes. History has never been shy about teaching lessons. During the dot-com bubble of the 2000s, those who chased high prices were trapped for a decade, while investors holding cash and value stocks survived. During the 2008 financial crisis, the stock market crashed, but the price of gold soared from $700 to $1,900, far outperforming most other assets. Japan's three lost decades further demonstrate that, once the real estate and stock bubbles burst, preserving wealth often requires holding cash and safe haven assets. The message is clear: don't blindly chase bubbles, but also don't liquidate too early. The best strategy is to maintain a diversified portfolio while keeping defensive positions. In this environment, retail investors don't need to chase every bit of news. They need to keep a close eye on a few key indicators. For example, if non-farm payrolls fall below 50,000 for several consecutive months, it's almost certainly a sign of an impending recession. Similarly, if S&P 500 earnings growth diverges from stock prices, it signals an overvalued market. Finally, if the 10-year Treasury yield suddenly spikes, it indicates that investors are withdrawing capital from the stock market. When two of these three signals turn red simultaneously, the market is likely to reverse. The market's extravagance will always be intoxicating, but true wisdom lies in keeping your eyes on the exit while others revel in the music and cheers. Be ready to exit safely the moment the lights go out.